Hello, guys. How you doing?
G'day, Woody. I'm all right, mate.
Yeah, good. So for those
G'day.
hey Maz, for those watching, I thought I'd get Murray and Greg on have a bit of a chat. Lots has happened this week, as you can probably see, the markets are falling. The general agreement is that on Friday, obviously, there was much higher than expected inflation numbers, and I believe it's pretty widely expected that interest rates will get hiked again after tomorrow's meeting by the Fed. So I thought we'd get you guys on to check out your thoughts on it. Muz, let's start with you. In your latest email to Pivot Trader readers, you do highlight a few key quotes from Druckenmiller, Stan Druckenmiller, famous investor, and he made the point that it's been very few times in history where inflation has gotten above 4.5%, and we've been able to engineer, or central banks have been able to engineer, a soft landing. And he also notes that once inflation is above 5%, it's never come down without rates going above CPI, and CPI, real CPI, is around 8%. So why don't you set the scene for us? I know you've been following this very closely, and I believe you were calling this about 9 months ago too. There was a big, in the S&P, there was a what your system calls a sell pivot, which basically told you that trouble was coming. So what are your thoughts?
Yeah, look, we're sort of entering the end game, I guess. This is something that I've been discussing for quite a while, and we're sort of getting to the point where we're now having forced liquidations, and there can be more to come. And yeah, as you said, inflation at 8%, 10-year bonds down at currently 3.4%, and I'll show you the chart in a second. And the actual rates much lower than that for the Fed, so they're way behind at the moment, the 8 ball, and they've got a lot of work to do to bring things under control. And now look, I listened to the story that inflation is not going to sit at 8% for the next 2 years unencumbered. It's going to come off these levels. This is real sort of spiky highs that we're seeing at the moment. But I think the story is now there that inflation is not going to spike as people thought and then come straight back down to 2%. There are things in the system that are now working their way through. It's going to take time, and the Fed is a long way behind, and the market's now realizing that the Fed's serious about chasing it down, and the Fed is probably engineering for asset prices to come back off and for things to slow down to bring inflation back under control. So I think it's a real awakening for the market that, hey, this is real. It's not going to just roll over quickly and then we're all going to go back to things as usual. It is actually a paradigm shift that's, as a lot of articles I'm reading at the moment, talking about the 70s, because it's the last time, it's a generation. And that's why I want to show you this chart right now, is to show you that last generation of rates falling, since the Volcker moment. And it feels like we're at the moment where that's now, changing, a changing of the guard. So let's jump over to the 10-year bond yield chart, something that I keep showing people in my sort of weekly videos and that sort of thing, because I think it's a very interesting chart. And so this is the bond yield, which means you can see over here the actual yield on the right-hand side. So when yields are falling, that means the price of those bonds is going up. And when the yield is going up, the price of those bonds is going down. So it's a bit of a strange chart from that point of view. You have to have that in your head. That's what's going on. And what I want you to note is over the past, since early 80s, we're talking a very long time, 40 years of a very steady downtrend in yields. And what I want you to note is the highest high of that downtrend all the way down. You can see it's never been under threat for 4 decades. And now here we are with the highest yield we've seen. This is the previous highest wave within this 40-year downtrend.
Yeah. And
here we are with yields just the other day from the weekend, actually, with that inflation figure going through. That was the catalyst to see the 10-year yield bust up through that high. So what we're looking at here is the first time in 40 years where the downtrend has actually been under threat. And it's as a result of inflation coming out way higher than expected. And what I'm thinking about now is not necessarily the future path of inflation. I'm thinking about forced liquidation. There's a lot of leverage in the system. There's like risk parity funds, which are really quite highly leveraged, and they invest into stocks and bonds, but with a very leveraged portfolio in the bonds, because that matches out their risk over time. Because usually stocks go up, bonds go down, stocks go down, bonds go up. So, when you've got that portfolio, everything matches out over time. But we're in a situation now where stocks are going down and bonds are going down, and you've got these very leveraged, very large funds. At what point do they start to have forced deleveraging? And I'd say having a trend break of a 40-year trend is a point when you might start seeing some serious deleveraging from very big investors. So I guess that's the thing I'm looking at the moment, is we're seeing some very big long-term trend breaks, and we've got the news to back up why those things are happening. So we're sort of in that phase of capitulation, of everyone waking up to the things that really we've been talking about for months.
What do you think, Greg? I know your take on it is slightly different. It all stems from inflation, though, still. Do you think this is the end of a 40-year cycle? I know in your recent update to advisory members that you said that you expected the bear market to kind of grind on for the next 3 to 4 months, but you think that inflation, because of the recession, will have to come off, and in which case the Feds are actually looking for an excuse to loosen again. Is that a correct summarization of what?
Yeah, pretty much, Woody. So the idea is that the Fed is going to engineer a recession in order to try to control inflation. And as I put in the essay in today's Insider, to show some evidence of that, the yield curve in the US is signaling that a recession is pretty close at hand. Now, I explain what I mean in the update, so you can look at the numbers there. But essentially, what's happening is the Fed is raising rates to such an extent, and I think it's been the last time they raised this aggressively was back in the 1980s, and this is the last time we're having this conversation about such high inflation levels. And the reading that came out on Friday, I think, was around 8.6%, which was the highest since the early 1980s. So the Fed is being very aggressive in trying to raise interest rates. And my view is that now we have such a huge amount of debt in the system that they will be successful in squeezing a lot of inflation out of the system. The only issue from my perspective there, if you look at a lot of commodity prices, they've all rolled over. They're well off their peaks. If you look at another chart I've got in today's issue is the 10-year break-even inflation rate. That's a market implied estimate of what the long-term inflation rate is going to be. Now, that peaked back in April of this year. April the 21st, it peaked at over 3%. It's now actually around 2.6%. So the implied pricing from the market is saying that longer-term inflation isn't going to be an issue. Short-term, that's what the market's concerned about. The market's concerned about the Fed being very aggressive in the short term to try to get this inflation under control. And what that's actually doing is raising the real interest rate. And when real interest rates increase, that's very negative for asset prices. And whether those asset prices are property, stocks, bonds, doesn't matter. When real interest rates rise, that's going to cause a headache for all sorts of asset prices. But the one thing I'm looking at that isn't budging so much at the moment is the oil price. And we all know that oil and energy has big long-term implications for the inflation rate. So, does the Fed keep raising interest rates to try to control the oil price, or is it just trying to raise interest rates to slow down the economy and get inflation, say, back under 5% within the next couple of months? And that's the biggest question that I've got. And now talking about this September, my sort of idea was that the Fed's going to raise interest rates at their meeting, which is we should know that by tomorrow. Yep. They've got another meeting in late July and then another meeting in September. Now, you also got to remember at the start of September, quantitative tightening increases considerably as well. So that's the other form of tightening that's going on at the moment, is the Fed is selling its bonds, shrinking its balance sheet. The last time the Fed tried to do that in 2018 caused a market crash of 20% in a matter of a couple of months after they ratcheted QT up after the first couple of quarters. So they're going to do that again in September. And my view is by the time that rolls around, we'll have another couple of interest rate rises. We'll have another couple of readings on inflation. And my sort of feeling is the Fed is probably closer to maybe sitting on their hands for a few months after September rather than continuing to raise rates. Now, I know that's not the view of the market at the moment. They're pricing in a very aggressive Fed, but I think we might have a different story on our hands. If you look at the stock market,
stocks might have crashed another 20%
absolutely.
by then.
And the stock market is already pricing in lower earnings, a slower economy. That a lot of this stuff's already been priced in. So, as I said, I think within a couple of months' time, we might be having a different conversation here.
But what hasn't been priced in is what you just spoke about towards the end of your intro bit there, where you mentioned there could be there's some deleveraging event happening. Do you have any idea of where that could come from, or is it just something that you're looking at?
This is just when momentum really turns. This is just something I've witnessed for 30 years. You know, it can take, like, let's say in 2008, it sold off over the 2008, but slowly. There was no real panic. There was a sort of slow selling off. Things were looking pretty bad, but then they trying to bounce. It was post Lehman that the sort of forced liquidations really came out, but the market had already sold off quite a long way by then. So we're sort of in the early phases. For me, the long-term trend in the US is only just about to shift now. And if I switch again to the charts just quickly, if I look here at the S&P 500 with a monthly chart, and I'm looking at my, just my simple moving average that I use, which is the 10-period exponential and the 20-period simple, and we look over the last few decades, here's the trend shift in 2000, here's the trend shift in 2008, and now we've had an uptrend since 2010 with only one false signal there, which then turned straight back up. So we've been in this uptrend for 12 years. Here we are with the trend just about to shift. Now, as far as that's concerned, this could still be early days. And also, if you look at the rally that we've had since the 2020 low, and this is how I look at these waves and how they move, you can see that where prices are, we're still in the top section. We haven't even reached the midpoint. And I'd say on this sell-off, we're probably going to hit that midpoint. So that's down at 3,500, another 250 points. But where this probably bottoms out for me is, possibly all the way down in that buy zone, under 3,000. And if we were then to look at, the trend up since 2008, pretty much it would be saying that we've had this blow-off rally and we could end up selling off all the way down to there and still be hitting the trend line up from 2009. And we could turn up from there and that overall uptrend would still be intact. Mm-hmm. So we can still see markets selling off a long way because it's been bought up so hard post the 2020 crash. They just threw the kitchen sink at it as far as trying to support markets and with printed money and expanding balance sheets. And in the end, they've ignited inflation. And that heat in the market that was created post 2020, that heat can come out because it's mostly hot air as far as I'm concerned. So a balancing up or a mean reversion could still see prices head a lot lower. And as Greg's saying, this could happen in the next few months as they really ramp rates higher. Stocks could really sell off as we hit the point of pain, I guess, the pain threshold, which we haven't really seen. Trends have been so strong. The big boys don't really start selling until that long-term trend is shifting. And once it really starts selling off, that's when those big leveraged funds start saying, right, we're out. And once they start selling, that's when you can get those really big cascading moves down.
In terms of the Aussie market, Muzz, I know you made the point that the point of the control for the wave since the COVID crash has been around 6,000, right?
Yeah.
And it's still way above that too.
Yeah, exactly. So there can be a large sell-off and structurally the really long-term big picture can still look fine. So we're sort of at the point where that momentum is about to shift, where that long-term trend is starting to go. We're at the lows. We're sort of at the point where any more bad news, we're going to start seeing that real panic selling. And look, if we do then see that, I'm probably in agreement with Greg that a really big shift down would kick the stuffing out of inflation for starters, and would probably have the Fed starting to get a little worried. And then they might start to soften their tone in a few months once they've started to ratchet up rates a bit. But, in between now and when they soften their tone, the market could sell off a lot further. And certainly the technical situation is very much on edge.
Yeah, sorry, Greg.
I was just going to add to that. I don't know if you've got an Aussie market chart there, Muzz, but one big difference between the Aussie market and the US market, as you point out there, Muzz, post-COVID, the amount of money that went into tech and went into, speculative frenzy of so many stocks that didn't have a great deal of earnings. Now, there was, of course, the Microsofts and the Googles and Amazons that benefited hugely from the lockdowns, and that went a long way towards pushing the US market up. The Aussie market has barely went above its pre-COVID highs, and now we're back below the pre-COVID highs. So in many respects, I think the Aussie market is better placed than the US market now, purely because we didn't have that blow off top. We didn't have that huge amount of speculative heat that was in the market. And I think the fact that we are a very resource heavy stock market puts us in a lot better position to benefit. I mean, I just I wrote in the intro to this, the Aussie market after yesterday's sell-off is only 12.4% from its highs of last August. So we are coming up to a year, a bear market of a year, which is a reasonable length of time for a bear market. I mean, I'd say the average bear market is probably around about 12 to 18 months. So we're sort of getting towards a decent length of time for a bear market. We're only off 12%, but the amount of stocks underneath the surface that have been, really, really knocked around in this bear market has been quite considerable. So even though I think there is more downside as central banks continue to raise rates, and that's just going to be a headwind for stocks for the next couple of months. But I do see lots of value opportunities starting to emerge for the first time in a long time. So, as hard as it is to deal with bear markets and look at prices and think, holy, I never expected this stock to fall to this level. You've got to understand that in bear markets, in the same as bull markets, prices don't necessarily represent value. Prices represent the psychological state of the market. And in a bull market, prices can be way above fair value. And in a bear market, prices can be way below fair value. And you just need to understand that psychology. And if you do have a time horizon of longer than six to 12 months, then I think by sticking with quality stocks that are paying a good dividend, while we're in this tough stage of the market, you're going to come out the other side pretty good. And if you've got some cash to allocate to stocks as the values emerge, then you're going to set yourself up well to be there for the next bull market when it does emerge.
There was an internal email just a couple of days ago from Callum. Actually, he sent around that he is seeing screaming buys at the moment in the small cap sector. I don't think he's ready to pile in just yet, but he's seeing some really good, compelling opportunity. So maybe we'll get him and Ryan Dintz. Ryan Dintz was going to join us actually today, but he's busy writing his update, but maybe we can get them both on later on. But let's talk about those opportunities a little bit more. So Murray, one of your, I was looking at your back page, your buy list at the moment. There's only three, with all this carnage going on, there is only three of your picks that are underwater. What are you doing?
Yeah, well, my whole philosophy over the last year has been to be really sparing, really. I've got some long-term positions that are well in the money where we've taken 2 chunks of profit. But I've been very careful because, as I've been saying, I've been thinking this is what's on the way. And what you don't want to do is when the market's making a topping formation, which can take a year to take shape, you don't want to be then loading up on stocks at those prices, because when things turn down, you are panicking out like everyone else. So it really has been a case of I've only been willing to trade when I've seen something that's just absolutely jumped out at me that I just have to have a go at. Yeah. And so that's probably been the lowest active that I've been since starting the service nearly 4 years ago. So, I think that's part of it is that I was bearish. And so I was nervous to be adding too many things. And I've been taking lots of profits and telling everyone, just batten down the hatches. And I've just really been waiting on this thing to fall over. And as Greg was saying, we have been holding up really well. But with the 50 basis point rate rise in Australia last week, that really pulled the rug out from under the banks. And the banks is the reason why we've been holding up so well. So everything else has been selling off in a terrible bear market. But the banks, which are, a huge part of our index, have been seeing money flowing in. And now they're looking a bit overbought. And with rates rising, property possibly, let's see how that plays out in the next 6 months in property land. And a lot of these fixed interest, that has been built up over the last few years, they'll be rolling off, and all of a sudden the mortgages will be doubling. So there could be some pain coming down the pike. So the banks are reacting to that. So that having that pillar sort of pulled out from under the market means I think we might have a bit of catch up as far as the index goes, with the banks possibly being quite weak. But I do agree with Greg that ultimately, a short US, long Australia spread is probably a pretty sensible approach. I think Australia will ultimately come out of this pretty well. There's apparently nearly $3 trillion being spent more on commodities this year than pre-COVID, which is about 5% of commodities. So there's a lot more money flowing into commodities. The prices are really through the roof, and that bull market, there's no real signs that's going to stop anytime soon. So I think commodities is the place to be when you're looking for, picking up the pieces at the end of the carnage.
And we spoke earlier on the yield curve and how the yield curve was suggesting the US economy is going into a recession. The yield curve in Australia is very, very steep. It's still, reflecting a reasonably healthy economy. So I don't think the risks to Australia's economic situation at the moment, as priced by the bond market, nowhere near as acute as what we're seeing in the US. So I think that's a positive as well. And as Muzz said, that's partly because of the income that we're getting from commodities. I mean, iron ore prices, they're well off their highs, but they're still very strong. Yep. Coal prices are at record highs, and coal's one of our most highest earning exports. You've got gas, LNG prices. We're a huge exporter of LNG. I think the second largest in the world. So there's a huge amount of income that's coming through into this economy based on these big commodities that we're exporting that is benefiting our economy. So that's a positive as well.
But isn't just the devil's advocate? Isn't Australia's debt levels rising just as anyone else though? And or do you think that the income from commodities exports will kind of offset some of that?
Household debt.
I remember our good friend Dan Dennings. He always had this saying: "We had the biggest bull market in history last time, and we forgot to get rich out of it." Is that going to happen again, or is that you pretty bullish?
I think as long as commodity prices stay healthy and that underwrites our national income, then you can sustain a reasonably high debt level. Our household debt levels are very high. Our government debt to GDP is relatively low compared to a lot of other countries around the world, but it's really our household debt levels that are high. But as I said, as long as the commodity prices stay high and generate enough national income to support that debt, I think it's not going to be in any way sort of a disaster or any huge risk. It's when you get a big drop off in commodity prices, a big fall in national income, that's when you see foreigners start to worry about financing our deficits, financing the household debt. The dollar will fall. Even now, though, the dollar's quite low. It just fell under 70 cents again recently, and that helps to underpin support for our economy as well. So, there's a lot of there's clearly risks out there, but I think as long as we have a reasonably strong commodity sector, I think that supports us pretty well.
So there you go. I think what you can sum up nicely this chat is short US, long Australia. Sounds like you're both pretty bullish and on the commodity sector, and it looks like there should be some value placed in that space. So what we'll do is so there's a rate decision coming tomorrow. I think during this time we'll have a lot more of these chats, and hopefully we can have one later on in the week with a couple of the other analysts to see what their take is in their relevant fields. What do you say?
Sounds good. Sounds good, mate.
All right, Murray, thanks so much for your time.
All right,
and
cheers,
Greg,
mate.
Greg, thanks, mate. And I hope everyone at home enjoyed this and found it valuable. Till next time.